This video will help you understand why an inherited traditional IRA doesn't matter for the purposes of doing a backdoor Roth IRA. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. A inherited traditional IRA does not trigger pro-rata aggregation rules as it pertains to backdoor Roth conversions. Now, if that made complete sense to you, then that's the genesis of today's video. If it didn't make complete sense, totally fine, stay tuned. We'll dive into why that sentence actually does make sense when you understand some of the nuance. And so let's jump in. So a very common tactic in the financial planning space nowadays are backdoor Roth IRAs. And ultimately that applies to those on the higher thresholds of income who make too much money to directly fund a Roth IRA. And if you're not sure if that applies to you, I'll link above to an explainer video that breaks down which IRA moves are permitted based on which income thresholds. But let's fast forward and say you make too much money to directly fund a Roth IRA, you've done a bunch of other planning ideas, and you still want to get money inside of a Roth IRA. Well, one strategy to make this happen is to do what's called a backdoor Roth IRA. And it's totally legal, so don't even worry about that. For an explainer on how to do a backdoor Roth IRA, I'll link above here. At the end of the day, it comes down to funding a traditional IRA in a non-deductible fashion, and then doing a Roth conversion as soon as possible. Theoretically, since you're never taking a tax deduction on funding the IRA, when you do the conversion, you're only converting after-tax money, which means you won't owe any taxes on the Roth conversion, unless you have existing pre-tax traditional IRA money already on the balance sheet. As some of you may be aware, if you already have an existing traditional IRA on the balance sheet, the IRS pools all of your pre-tax and non-deductible IRA money together when you're doing the Roth conversion for the backdoor Roth IRA, and thus they prorate how much of the Roth conversion is tax-free and how much will be income taxable based on the percentages of your total IRA balances you have between those two tax types. Now, Roth IRAs aren't aggregated with traditional IRAs, but non-deductible traditional IRA and pre-tax traditional IRA money, that's aggregated together. For a quick example, let's say you had a $93,000 old 401k to IRA rollover you did a couple years ago. Well, now when you go to do the backdoor Roth IRA and say you put $7,000 into a newly opened traditional IRA, the IRS is going to look at that $100,000 of IRA money and say, okay, when you go do your Roth conversion, we're going to pro-rata aggregate and say 93% of that Roth conversion is income taxable, and only 7% of that Roth conversion is income tax-free. Now, if your goal was to pay as little in tax as possible this year, then that's not the strategy you want to take. A very simple solution is to move your traditional IRA money pre-tax into your existing 401k or employer-sponsored plan. But you can't do that if you have a SEP IRA or a simple IRA. I mean, you could move the IRA money into there, but that wouldn't help solve this problem because the IRA pools all of your IRA money together, including SEP IRA and simple IRA money. In that situation, you might be SOL for fixing this ahead of time. Now let's enter into the equation an inherited traditional IRA. Intuitively, based on the previously aforementioned rules, you might think, okay, well that money comes through the door, therefore that's traditional IRA money on my balance sheet. So even if I were to do backdoor Roth IRAs for years and years, then I get this inherited traditional IRA, intuitively you might think, oh, I don't want to trigger any pro-rata aggregation. Well, the good news is inherited traditional IRAs are a special carve-out that the IRS provides where they do not pro-rata aggregate that money with your other IRA balances. Now, also good to know, an inherited traditional IRA can't be Roth converted. You also can't roll that into your existing 401k, but you don't need to worry about that if your goal is to do backdoor Roth IRAs or continue to do those. The inherited traditional IRA will not disturb that strategy. Now, bonus tip, if you did inherit a traditional IRA, you know how we're talking about non-deductible money? Well, it's totally possible you inherited a traditional IRA that had non-deductible traditional IRA money already in it. And that's not necessarily because your loved one was doing backdoor Roth IRAs. It was actually pretty common back in the day if someone was incomed out from funding a Roth IRA, that they would just fund their traditional IRA in a non-deductible fashion on purpose. And that way they could still achieve tax deferral on the growth of those funds. Or, and most likely what was probably the case if there is non-deductible money inside the IRA, is they were funding a traditional IRA thinking they were getting a tax deduction, but their CPA or their tax software automatically just coded that contribution as a non-deductible contribution because they weren't permitted to take a tax deduction. So while they thought they were getting tax deductions, they actually weren't. And you don't really ever know that if you read through your own tax return after pressing submit, which I don't think most people do. I think they just hit the big red button, stroke a check to the IRS for whatever they owe, and then move on with their year. But what you want to do if you inherit a traditional IRA, Two things. One, I'd check with the decedent's advisor and see if they had been doing any backdoor Roth IRAs or if there was any non-deductible traditional IRA money inside that IRA. That way, you know when you take money out of the IRA that you don't have to pay income taxes on all the distributions because a portion already had income taxes paid. You can also check the prior year tax returns for the decedent, and specifically, you're going to want to look for Form 8606. Now, you don't need to file an 8606 every year that there is existing non-deductible IRA money in the account. You technically only need to file it in the year you made the non-deductible contribution, but a best practice is to file that every year. So unfortunately, checking with the advisor then checking the tax return are both very fallible methods of finding non-deductible IRA money. If the decedent didn't keep super good records, you might just be SOL and pay income taxes on the distributions, but it is what it is. Okay, so from a calls to action standpoint, if you inherit a traditional IRA, I would check with the advisor and the prior year tax returns to see if there's any non-deductible IRA money in there. A call to action, I suppose, for you now, if you did inherit an IRA or know someone that did, is that the inherited IRA will not disturb your backdoor Roth IRA strategies. And I suppose lastly, if you're in a high income tax bracket and you've been funding a Roth IRA, but you shouldn't be, I'd recommend stop doing that and look into maybe a backdoor Roth IRA strategy. And you can check out some of my previous videos on how to do that and know if you're in those income thresholds. So hopefully that was helpful. If you have further questions, drop them in the comments below or get in touch with the website. We'll help you get squared away. Have an awesome rest of your day. We'll talk to you later. Bye.